So another rate hike, a jumbo rate hike from Bank of Canada, that is showing some slowdown in their rate hike progress. That's started back in March, and some data came out from Stats Canada also showing some weak economic outlook in this country. So what does it mean for the economy overall? What does it mean for the housing sector? How this is going to shape up the overall real estate driven economy in this country? So in this video, we're going to cover all of this. So stay tuned till the end. Let's dive in. Okay, so first thing is the Bank of Canada's rate announcement. So what we have seen is they came out with 0.5% rate hike, which is not expected by the market. The market was pricing in for 0.75%. Now that is showing some sort of a potential pivot coming in the next quarter or so, because if the rate hike is kind of decreasing, and we saw that from 1% to 0.75%, then 0.5%, so that is showing you a slowdown in their aggressiveness, but it is still a significant rate hike compared to what we have seen in the past. So that has pushed up the variable interest rate mortgages quite high. So the overnight rate has gone to 3.75%, which has now pushed the prime rate up. Now what we're seeing, the 5-year fixed right now is 5.6% as per RBC, and 5-year variable has gone to 5.78%. So your 5-year variable is higher than your 5-year fixed. Typically it is other way around, and people tends to take variable mortgages just because it actually offers you better rate compared to the fixed contract. So that's how things are getting messier and things are looking upside down. And the reason is the 5-year fixed is actually adjusted based upon the bond yield. So when you look at the Canadian 5-year bond yield, what it is showing you is right on 3.39%. Okay, so it has gone down from its peak. The peak was around 3.9% we saw last month, and since then it is dropping a little bit down. And the reason is the market is expecting some sort of pivot going forward from Bank of Canada, right? So they have seen their aggressiveness is kind of coming down from 1% rate hike to 0.75 and now 0.5, maybe 0.25 next time, and then they take a pause. Okay, so that's showing some sort of a potential pivot coming from Bank of Canada. It is not guaranteed, but the market is expecting it. Okay, and which is why we are seeing a reduction in the bond yield that is also going to impact or influence the 5-year fixed mortgage rates as well. Now, if we look at the real life example, it is still significantly higher interest rate. So people who have taken mortgages either as a mortgage origination or renew their mortgages, and they capped at variable rate, let's say if the mortgage was taken out in the last 2 years, they are now seeing significant increase in their monthly payments based upon the variable rate interest rate. So I know personally, a few friends who have purchased property last year, taken variable mortgage, and it is not uncommon to have $1 million mortgage in GTA, because the average property prices in the last 2 years were going above 1 million mark, and people who have that high mortgages, they are now seeing a significant increase in their monthly payment. So things are not looking good for those people. And what we also saw that Stats Canada published their GDP growth numbers for the month of August, and it is showing 0.1% growth. Okay, and much of that growth came from the services sector, like retail, and the manufacturing sector is struggling. So basically, manufacturing sector shows a decline in GDP growth, which is offset by the service sector growth. Now that is showing you that we are seeing reduction in the manufacturing sector, which means possible recession coming, because when you see the bond yields are kind of inverted, because if you look at the 2-year treasury yield and 5-year treasury yield, there is an inversion. Typically you see a higher rate on the 5-year bond compared to 2 years, because the risk you carry on the longer term bond is higher. That's why you expect higher rate of return on those longer term bond. But right now, both in US and Canada, it is showing an inversion, and that is typically a sign that we are actually going into a possible economic slowdown or recession very, very soon. Maybe in the next 6 to 12 months, who knows. But history has shown you that this has happened in the past many times. Whenever these bond yields gets inverted, it is followed by a economic recession. Now, the other thing I want to cover is if you look at the TerraNet data that came out past week, according to them, the home price index that they measure, and they have been measuring since 1999, and we have seen a record broken in the month of August, and that record is also already broken again this month as well. So we saw 3.1% decline in home price index as per TerraNet National Bank National Composite Home Price Index. That is the largest decline since its inception, since 1999. And much of that price decline has been seen in Ontario. For example, Peterborough has shown 11.8% decline, Windsor 5.4% decline, and Belleville 5.1%. So significant reduction in price across Ontario as well as in BC, and that is showing slowdown in the real estate market. We have not seen this since 2008, by the way. This is very difficult time for people who have purchased the properties at least in the last 2 years. So people are asking me, hey, what's going to happen? What is the outlook? Well, the outlook is looking very weak because we are seeing GDP contracting. We are seeing reduction in the manufacturing sector, which is now being offset by the services. But services can also go into economic tough times as well, because when you see the Canadians' net wealth is being decreased significantly. By the way, as per RBC report, they showed that the Canadians have gained their net wealth up to $4 trillion in the last 2 years during pandemic. And since February or March, when Bank of Canada started their monetary tightening, that net wealth has gone down $1 trillion already. And they're forecasting it is going to take up to $1.6 trillion. So Canadians are losing their net wealth, which will affect their purchasing power, because when you see your net wealth is being decreased, you typically tend to reduce your spending in the economy, right? So when you reduce your spending, the other person on the other side is also getting less earning, because remember, one person's spending is another person's earning. If you're not spending enough, the other guys in the economy are not earning enough. So that is going to slow down the overall economic activity, and which will also result into the overall economic growth, which means recession in the end. So I'm not seeing any positive outlook, to be honest, until we control the inflation and then it kickstart the economy somehow. So until then, we cannot see anything going up from here. Further price declines are expected, and the inflation looks very structural, because interest rate is not going to control inflation at completely, because a lot of inflation factors are depending on the supply chain, lack of skills, and some energy input cost, which is going to impact. That's it from me this week. I hope this is helpful, and take care of your finances, guys. Don't leverage yourself too much, because things are not looking good. It's time to save money and take some safety measures, and don't leverage yourself. So until my next video, take care.